Delighted today to welcome Tom Williams, who's the manager of Downing Renewables Infrastructure Trust. And it's about 1.5 years old now, and it's just recently published its first set of accounts. So now seems quite a good idea to catch up with them. So I thought we'd just start with just one question. Why does your investment objective emphasise the importance of diversification, Tom?
I think it's two main reasons. The first is to increase the stability of returns, and the second is to access a wider pool of investments. I think the second is pretty obvious. You know, if we have different technologies that we're investing in different jurisdictions, then we just have a lot more pools that we can fish in. The first is a bit more of a complex answer. What you have is different renewable energy technologies are dependent on different resources. And those resources are seasonal and variable. And so you don't necessarily want to have all your eggs in one basket. You don't want to invest just in one technology. If you invest in a range of technologies, then you have a more diversified set of revenues. And also, those different technologies and different natural resources aren't necessarily correlated to one another. And when you have a combination of things that are not correlated to one another, you have a more resilient set of cash flows. So that's what we're all about. It's about that stability of cash flows of the portfolio as a whole, and your ability to access that wider pipeline of opportunities.
So how do you go about managing a portfolio like that with diversification across asset types and geographies? Do you need a really large investment team to do it?
Yeah, look, I think a large team helps. I think it's not just a large investment team. Actually, I think the most important thing to have is actually a large asset management team. And what do I mean by that? Well, a lot of these investments are simply in a company which owns a solar park, which is just a collection of panels and other equipment sitting in a field. Same with a wind farm. It's a turbine or a set of turbines out there, maybe in a forest in Scandinavia. These companies don't have employees, so they need people to help to operate, to help to look after, manage relationships with landowners, with regulators, with a whole variety of people, and of course to monitor and ensure that people who are doing the maintenance and the operations of these assets are doing their job. So we actually have very fortunate to have a team of around about 40 people. And more than 20 of whom are in that asset management function, solely focused on preserving and enhancing value in the assets.
Does that make DORE quite expensive to run? How's your fee worked out, and how does that compare to other similar funds?
So the good news is that the fee is calculated on net asset value at the size of the fund. Which is exactly the same as our peers, and our fee is absolutely in line with other funds of our size in the sector. So what does this mean? It means that the investors get the benefit of Downing dedicating this large, very large resource to the fund at no extra cost.
So far, I think in the portfolio you've got wind, solar, and hydroelectric. So what other kind of asset types are you thinking about?
Yeah, so we're looking at quite a few other technologies actually. So we're looking at battery storage in the UK and in the Nordics. We're looking at geothermal energy, which is predominantly in the Nordics. We're also looking at non-generation assets. So these are assets like electricity grids, district heating networks. We like these kinds of assets because they don't have any merchant power price risk. They don't sell energy for their revenues, and also they've got very long lives. Yeah, we really think those have got a real place in that diversified portfolio.
And then in terms of the positive impact that the fund has on tackling climate change, which one of those gives you the biggest bang for your buck?
Yeah, so that is a good point, of course. I mean, DORE is an Article 9 fund under SFDR, so there's a lot of terminology in that. But what it essentially boils down to is we are an impact fund, and we have a core sustainable objective, which is to further the transition to net zero through our investments. So we do think about this, we do think about the impact that our investments have. And so the way that I think about this impact is I think about how much energy per year each type of technology produces per unit of capacity. And so in the industry, that's known as a load factor. So hydropower is actually comfortably the highest load factor of the three technologies we've invested in. It can produce up to 24 hours a day, 365 days a year. So even with maintenance and seasonal water flows, you can get to 70, 80% load factors. Wind is next. So a good wind farm, you can get into the region of 35 to 45% load factor. And then solar is the lowest, particularly in the UK, where the irradiation is a bit like today, not the highest in the world. And you get around about a 15% load factor there.
Why do you have a focus on Northern Europe?
I think we like Northern Europe for three main reasons, actually. I think first and foremost is rule of law. So Northern European markets have more politically stable environments, and particularly their policy towards renewables are quite consistent. I think we also like them for ease of business. Northern Europe is a very transparent place to do business, and it also welcomes foreign investment. We have to be cognizant that as a UK-based investor, we are a foreign investor in the Nordics, but we find a very welcoming atmosphere there, and one that's really open for business. And we also like Northern Europe for the relationship between price and risk. Particularly the Nordic regions, actually, we find quite a less crowded space than other markets, and we find some really attractive returns for the kinds of assets that we're buying.
Fairly large exposure to Northern Ireland in the fund. Just looking at the map of where your investments are, does that have the same subsidy regime as the rest of the UK?
It's a slightly different regime, but very similar. They have a ROC regime, just like England, but it's called Northern Irish ROCs. The biggest differentiator for us actually is actually the energy markets, where you sell your energy rather than the subsidy. The Northern Ireland is part of the single electricity market, SEM, which is actually the unified Irish market, and that has a different set of price drivers from the UK energy markets.
And then just thinking about where your revenues are coming from, a lot of it is coming obviously from sales of power. So why are power prices different in different markets? For example, why are power prices different in Sweden and the UK? Again,
at the heart of why we like investing in different geographies, right? So there are different fundamentals of these drivers. As we know, at the UK, power prices are really high. So why are they high? It's the cost of carbon, and it's the cost of gas. And the reason why gas and carbon are driving the pricing is because gas-fired power plants set the price of electricity in the UK. And gas-fired power plants, fossil fuel, emits carbon, has to pay carbon tax. In Sweden, that is not the case. And actually what sets the price of power most of the time is actually hydroelectric power, which doesn't pay for its fuel and doesn't emit carbon, and so the prices there are much lower. And so in the UK, what you tend to have is very high prices at the moment, dipping down, then rising back up again around about 2030, and then tailing off as more and more renewables come online to get us to net zero. And so the long-term outlook is actually slightly downwards. In the Nordics, and in particular in Sweden, what you have actually is you're starting from a much, much lower base. Electricity is much cheaper there at the moment. And you have two main things going on. One is an increased interconnection with other parts of Europe where prices are higher. So that pushes prices up a little bit in the medium to long term. And also because prices are low in that part of the world, you have people moving energy intensive industries, things like data centers and things like that, to that part of the world, because that's one of the real big costs of those kinds of business. So very different outlooks, very different out-term pricing, all part of that strategy of diversification. Okay, that makes sense. So we did see that last year some funds were lowering their NAVs because they were saying that long-term power prices were going down. Do you actually think the trend might be going the other way at the moment? Yeah, look, I mean, it's hard for me to comment on other funds, but I can give you the perspective for DORE. So we think DORE is really, really well positioned in the current economic climate. So if you think about what's going on at the moment, I touched on high power prices. DORE sells power. That's obviously good. And of course, we're in an inflationary environment as well.
Yeah, and then inflation, is that actually going to be good news or bad news for the portfolio?
Inflation is good news for the portfolio. Why is that? Because 54% of the portfolio's revenues are, as at the end of December last year, are directly linked to inflation. So that's predominantly in the UK, and it's linked to the subsidy revenue that we have in the solar portfolio. And the balance of the revenues show a strong correlation to inflation. Why do I say that? Well, as an example, our assets sell electricity at wholesale power price. Wholesale power price is a part of retail power price. That's the price that you and I pay for our electricity. And of course, retail power price is a component in RPI, and that's one of the ways in which we measure inflation in the UK.
I think in other ways that your portfolio is sort of differentiated, how much of the portfolio is actually in assets that are being built? And are these sorts of investments riskier?
None at the moment is the answer. They are riskier than operational assets for obvious reasons. Having said that, we do look at construction opportunities, and we do think that the right ones can provide an attractive boost for small incremental risks that we think are very acceptable.
What kind of dividend yield do you get from investment in DORE?
Yeah, so we're targeting 5p per share this year.
And will those dividends rise over time?
Yeah, absolutely. So what we're doing is we're looking to increase the dividend steadily each year after this year on a progressive basis.
So most funds in this sector do borrow money to enhance returns. Is that something you've done with DORE's balance sheet as well?
We do think that prudent leverage has a place, and it does enhance returns. What we don't believe in is borrowing too much, though, as what it does is it increases risk, and it actually increases the volatility of your returns, and actually we're trying to do exactly the opposite of that. As at 31 December, we had some long-term borrowing in the portfolio that amounted to about 28% or so of the net asset value of the fund.
I think you last raised some money last October. So how much money you've got left to invest now?
Yeah, not much. So we spent pretty much all of the capital we raised to date. That's about 140 million or so. And essentially what we've got is we've got about 25 million in a revolving credit facility, which is a debt facility that sits at the fund level, which we use to acquire assets ahead of raising additional capital in the market. So it's a very short-term facility. We haven't drawn anything under that yet, but hope to do so because that means we'll be making more acquisitions.
Now, have you got plans to grow the trust? And if you did do that, how would that affect an existing shareholder?
Well, first of all, absolutely. We've got hugely ambitious plans for the company. What would the benefits be? The benefits would be a lower overall cost of managing the fund and increased liquidity for investors in the fund. I think also, if you take a step back, it would also mean that we're making more of an impact and more of an impact on our aim to accelerate that transition to net zero through our investments. So I think there are a number of benefits for investors of us getting a bit bigger.
It all sounds encouraging. So thanks very much, Tom, and good luck with it all.
Yeah, thanks very much. Thanks very much for having me on.
Thank you.